everyone, this is Lisa of Accounting Wise. Today we will be discussing business organizations. So let's take a look at some definitions of business organization or entity. One is it is a commercial organization that aims to gain profit from its business or operations. And next we have an organization that uses economic resources to provide goods or services to customers in exchange for money or other goods or services. Up next, we have forms of business entities: sole trader, partnership, corporation, and cooperative. We are going to take a look at each of them based on the following criteria: ownership, management, liability for unpaid debts and other obligations, capital, accounting, and auditing. So let's start with the sole trader. A sole trader or a sole proprietor usually has small operations. It is owned and managed by one person who is the owner. Liability for unpaid debts and other obligations. As a sole trader, the owner is personally liable. So, for example, if the business has a pending liability from a supplier and the business has no money to pay for it, so the owner will pay for it from his own pocket. Next, we have the capital. The capital is usually provided by the owner. Accounting and auditing. The business is private except for tax purposes. So what does this mean? It means that the profits of the business is treated as income of the owner and will form part of the calculation of his tax payable on income. Next, we have partnership. A partnership is created when two or more persons contributes money, property, or industry to the business for the purpose of dividing their profits among themselves. So the ownership is owned by two or more individuals working together as partners. Management, these are managed by the partners themselves. The liability for unpaid debts and other obligations. Partners are personally liable. So what does this mean? So for example, the partnership has an obligation or a pending liability that is already due for payment and the partnership has no money. So the partners will be liable to pay it from their own pocket. And of course, the payment is based on their agreed share. The capital is provided by the partners. Partners can contribute money, property, or service or industry. For accounting and auditing, the financial accounts are needed for the benefit of the partners for the purpose of calculating their share on the profits or losses of the business. So the profits are shared based on the partnership agreement, and each share of the partners are treated as personal income for the calculation of his or her tax payable as on income. Now let's take a look at corporation. Corporation is a special form of business entity. It is a legal entity separate and distinct from its owners. It has a legal personality, meaning the company can legally own assets and can sue or be sued. They are also taxed separately from the owners, meaning profits of the company are taxed as income of the company itself. So ownership is by shares under corporation. So how does this happen? So once the company issued shares for subscription to the public, individuals may buy shares from the issued shares of the company and they become shareholders or owners of the corporation. Management of the corporation are managed by professional managers. Uh, Managers are different or separate from the owners or shareholders. They are different individuals. So the separation of management and ownership is important because the information about the company's position and performance should be regularly reported by management to shareholders. This is the main purpose of financial reporting. So the possibility for managers to make false reports to shareholders is high. So the company laws, especially on financial reporting and auditing, are stricter as compared to sole trader and partnership. Liability for unpaid debts and other obligations. So, as we have said, um, corporation is a legal person. It has a legal personality. So the company has legal obligations to pay for its unpaid debts or obligations. Owners or shareholders are not normally held personally liable. Their liability is limited to the capital they invested in the company. So capital are raised by issuing shares to the public. So these are provided by the shareholders. Accounting and auditing are fairly strict for financial reporting and audits because of the separation of management and ownership and the because of the risk of reporting false reports to shareholders. Company laws are stricter, as I've said, as compared to sole trader and partnership. So now let's take a look at cooperative. Cooperative operates similar to some corporations. The purpose of cooperative is to realize economic, cultural, and social needs of its members and its surrounding community. One of the very important features of a cooperative is equity and equality among its members, meaning the voice of one is equal to the voice of any other members. Ownership of in a cooperative are owned by its members. Management are managed by elected managers from its members. Liability for unpaid debts and other obligations limited. Capital are raised or provided by its members. Accounting and auditing, fairly strict regulations for financial reporting and audits if incorporated. Now let's take a look at the types of business entities. We have service, merchandising, manufacturing, and hybrid. Service business entities provides intangible products, meaning no physical form, like professional skills, expertise, advice. Examples are schools, banks, law firms, repair shops. The merchandising business organization buys products at whole price and sells them at retail prices. Merchandising business are also known as the buy and sell business. Examples are the grocery stores and distributors. The manufacturing business organizations buys raw materials and transforms them into a new product. They combine raw materials, labor, and overhead to produce the product. So the finished product is then sold to the customers. Examples: food and beverage companies, clothing and accessories companies, and construction companies. The hybrid business organization may be classified into more than one type of business. So it can be a combination of the service business, manufacturing, or merchandising business. Examples, we have the restaurants, pharmaceutical companies, and malls.